Hello, everyone. Welcome, welcome. My name is Denzel Rodriguez, your personal finance geek of the 21st century. And today we're going to be talking about paying your mortgage off early, whether you should do it or not. We're going to look at an example here today. We're going to break the numbers down. I'm going to present three options of how one could go about accelerating their mortgage. And then we're going to focus in on one of those strategies, which is using a properly structured whole life insurance contract, and really analyze all of the components of the results of paying off a mortgage early. What does that look like using a whole life insurance contract? We're going to look at the full picture. We're going to look at all the benefits that come with that. We're going to look at the cons. And then what we want to do is compare alternatives. What would it look like if I did something else compared to putting my money in a whole life insurance contract, having that grow, then borrowing and paying off my mortgage with that asset. So basically using an asset to pay off another asset, being your home. Now, we are live as I'm recording this. So if you're in the house and it's your first time, please comment, let me know. If you've got questions throughout my presentation here, don't waste any time. Drop that question in the chat right away, and I will address all of the questions that pop up, and then we'll conclude. Okay? Before I go into the numbers, I want to address the way some of you are thinking about your personal finances and really just recognize the fact that you're a part of a group of people that are actually taking action on your personal finance. So I want to recognize you, pat on the back. I want to be your biggest cheerleader, that the fact that you're simply taking steps to really figure out, does this make sense? Does that make sense? You're asking lots of questions. I want to recognize that. I want to, cheer for you, for your family, because I want to say 50+% of what I do is just getting people to that stage to just simply believe that there's more for them as it relates to their personal finances. Getting them to believe that they can comprehend this information, that they can take massive action, achieve financial freedom, achieve financial independence, achieve all their financial goals that they want. I'd say 50+% of what I do is just getting them to that point. Now that you're part of the other group of people, that you've taken the action, you're studying, you're learning, you're processing information, now you're dissecting it. There's no dumb question here. There is no dumb strategy. There's no right or wrong strategy when it comes to your personal finances. That's the conclusion I've come to at this point in my financial journey, is there are no good or bad financial strategies necessarily. It's for me, it's, was that efficient under these circumstances for this particular situation, for this particular family? Does that strategy make sense for them? And it's either a yes or no. It's could also be an I don't know at the moment, I need more information. So wherever you're at on your journey, I want to, let you know that this environment, this community, there's no judgment. Any question you ask, right, I'm not gonna shoot you down. I'm not gonna call you crazy, stupid, ignorant. I'm simply gonna challenge your question with more questions, or I'm simply gonna run the numbers right here on the board and figure it out and have some fun with it. So I wanted to give that nice, healthy context before we dive in. With that, let's take it right to the whiteboard. Let me give you the full context of a scenario, of a situation. 4 major numbers on the left-hand side of the board here. We have an individual that's generating $15,450 a month net take home. We have total expenses at $10,950. Total debt, a little over $650,000. All of that debt is a mortgage. That's it. Person has no other debts, just a mortgage. So that leaves us with a free cash flow, money that has not been purposed yet, money that's left over each and every month of $4,500. We have a 40-year-old male here, and this person has come to the conclusion that they want to pay off their mortgage early. They want to accelerate it based on the content that they've been watching, the education that they've been consuming. They're like, Denzel, this is what I want to do. I want to pay off my mortgage faster than normal, faster than the 30-year loan term agreement. I want to pay it off faster than that. My issue is figuring out which one makes the most sense for me. So I'm presenting 3 strategies that do not involve taking risk in the sense of putting money somewhere where it can grow, where it has the potential of losing money. So these 3 strategies I'm presenting are not scenarios where you put money into this strategy and can essentially lose it from some sort of investment. So this is not an investing strategy. We can talk about that, no doubt. Right? We can talk about how you could, instead of making extra payments to your mortgage, we could talk about what if you took those extra dollars, put it in an investment. That means you're going to take on risk to grow that money larger than the mortgage in a shorter period of time, and then take that wealth that you accumulated and then paid off the mortgage, but still have more money because you're investing. So you're earning more than your cost of your mortgage rate. So we're not going to talk about investing. Although if you got a question you want to talk about it, feel free, drop it in the comments. We'll address it. So the 3 strategies I'm presenting here today are debt snowball. That means making extra payments. And I'm going to give you the numbers so that you yourself can pause the video and pull up a calculator, pull up an amortization calculator, and run the numbers with me so that we can verify this stuff. I'm using debt snowball as a measurement stick to say anything other than making extra payments, we want to, base our decision making maybe off of that for a number of reasons. So we'll address that. So we have debt snowball, which is just making extra payments of that $4,500 toward the mortgage. The original mortgage loan amount was $660,000 at 6.75%. Today, now we're in May recording this video, but when I ran the numbers with the person, we're looking at April 1st, their mortgage was at $650,514.22. The principal and interest payment is $4,280.75. So you plug those numbers in, then put in extra payments, $4,500. You should get 9 years and 5 months. The mortgage will be paid off. So that's our standard to say, all right, if my desire is pay my mortgage off fast or faster than the 30-year term agreement, I say 9 years and 5 months is pretty good. At 40 years old, I'll be 49 and a half, completely debt-free. I have a paid-off property full of equity in there that I could potentially leverage for other investments later on. So that's snowball. and we can address some of the drawbacks of doing debt snowball that's often not discussed on the internet. What are some of the drawbacks of paying off your mortgage early via extra payments? Well, number one, if and when life happens, because you were sending all of your free cash flow, discretionary income toward that mortgage payment, you essentially have no liquidity for the next 9 years and 5 months. Would you agree? You have no liquidity whatsoever. Unless we have other assets, other retirement accounts, or other savings, that's a different story. Let's just say in this example, all we have is that cash flow right now, that $4,500, no savings whatsoever, and no other places to access cash other than borrowing. Okay? Many of you are set up that way. You don't have capital set aside outside of your strategy. Many don't have retirement accounts in America built up to anything that is accessible, so not liquid. So with that 4,500, biggest drawback is if and when life happens within those 9 years and 5 months, say a job loss, a death in the family, a divorce, a new child is born, one of your children get married, you have a child, what else? A major injury, you get hurt, a loved one gets hurt, car crash, car repairs, gotta buy a new car, the car is old. There's so many variables that could derail that 9-year and 5-month timeline, without a doubt. Because since I'm sending all my cash to the mortgage, I got no liquidity whatsoever. If an emergency comes up, I pretty much have to borrow to take care of that expense, or I put a pause on paying off my mortgage, and now I'm sending the cash flow somewhere else. That's a huge drawback. The second part is, part of part one is the liquidity factor. Like, you've got no liquidity once it's all said and done. So including the 9 years and 5 months, and even after you pay off your mortgage, you still have no liquidity whatsoever. The only way you are able to access all the equity in your home is if you borrow or sell. So you're still, wonderful. You paid off your house. You now have increased cash flow of almost $4,300. You're debt-free and broke. High cash flow for sure, but still you're debt-free and broke technically. Now you have to build from there at 49 years old. You now need to build your wealth from there because you dedicated the last 9 years to just paying off your house. I think a lot of people do that and are not looking at some of the drawbacks that come with that. Okay? So that is 9 years and 5 months. Then we have velocity banking, which, again, if you're brand new on the channel, go ahead, comment, let me know. But if you're seasoned on this channel, you've been here for some time, the velocity banking strategy is pretty much what a majority of us are using to not only accelerate mortgage debt, but all kinds of debts, if and when it makes sense. What I illustrated my own numbers, being super conservative, is doing velocity banking could accelerate the mortgage faster than 9 years and 5 months. So we go faster, technically. And you're done in 8 years and 6 months. Could be a little sooner, but really no later than 8 years and 9 months. 8 years and 9 months was like my super conservative number. 8 years and 6 months, so it's about almost a year faster. And then depending on what the rates are on your line of credit, as long as it stays below 6.75%, we could very possible to not just pay the house off, but also the line of credit at zero by around year 8. So I'd say 8 years being the fastest, 8 years and 6 months. So that's my range that I'm giving, and that's pretty much using a home equity line of credit, second position. You get an intro rate today less than 6.75%. That's not hard to do. And then stay below prime or prime minus on a HELOC, very possible. Could eventually refinance into a first lien and go even faster. And there's a bunch of other things that we can do, like removing escrow from the mortgage, running bills through a credit card, getting cashback rewards, tons of different things we can do to really get to this timeline. And then we have infinite banking. So infinite banking, I'm referring to using a whole life insurance contract, where instead of sending that $45 every month to the mortgage, or even inside of a line of credit and then doing the chunking strategy, where you're taking lump sums and making principal lump sum payments into the mortgage, and then you're doing velocity banking, essentially canceling interest, offsetting interest. That's where you get that shorter timeline. Instead of doing that, infinite banking shows us how we can take that 45, purchase another asset, life insurance. You get a death benefit out the gate, you get living benefits, and then you get a cash value component where that money starts to grow tax-free, grows on a guaranteed basis, and can be used tax-free via loans or withdrawals. In this case, I'm going to illustrate using a loan. And the timeline that I have here is 10 years. So it takes longer than debt snowball and velocity banking. So that's an immediate drawback, is that it takes longer, still faster than the 30-year timeline, of course. So at 40, if I do infinite banking, home's paid off by 50, but we're not done there. There's still more at that point that we'll need to analyze and look at to really factor in the full strategy and see if this truly makes sense, if it's worth doing. So what I'm illustrating, and I'll even share my screen to get a little more context. You take the $4,500 a month, times that by 12, you should get $54,000. So this right here is showing the cash value growth year over year in a properly structured whole life insurance contract where the focus is high cash value, minimal insurance premium costs to maximize cash value growth in the early years and even long term. The company that I'm showing here is MassMutual, using the high early cash value product. And this is showing what the cash value will look like at the end of each year. So year one, put in $54,000. Day one cash value at the end of year one, somewhere around $49,961. The gross dividend rate in 2025 for MassMutual, I believe, is 6.1%, if not 6, but I believe it's 6.1%. So my illustration is based off of a gross growth rate, 6.1% over this period of time. And again, the company and the type of design is a high early cash value design. So we have $49,961, day one. Year two, at the end of year two, 102. Year three, 158. By year four, what I've paid into the policy is now reflecting in the cash value. So $216,361. So that's my break-even point by roughly year four. all my contributions are now showing up in cash value. That means from this point onward, I'm in the green. One of the drawbacks, another drawback here is when you are funding a whole life insurance contract, it takes sometimes 4, 5, 6, 7 years, depending on how you design it, before you actually see a positive growth rate compared to your principal dollars going in. Why is that? Well, because you're purchasing life insurance. So you're getting a death benefit that grows as your cash value grows. In this case, the starting death benefit is a little over $1 million. So in the first year, my $54,000 purchased me $1.3 million of death benefit. So you can say, okay, well, one of the pros is by me funding an asset at age 40, I protect my family with a $1.3 million death benefit in case anything happens to me along the way of this debt-free journey. If I pass away too soon before I'm done paying off the mortgage, my family will get $1.3 million or more, which will be more than enough to cover the mortgage and have money left over to basically supplement that person's income for a period of time. That's not something you get with Debt Snowball or Velocity Banking. So as we're walking through this scenario here, I want you to really put all this into your situation and process, what's going to make the most sense for me. And let's really think multi-layer this out. I want you to think multiple layers. I don't want you to just think surface level, whichever is the fastest one, that's the one I'm going to go with. I don't want you to just think that, although speed does have value, no doubt. And maybe there's a world where you can incorporate everything that you see here. So I want you to think outside the box. I want you to ask questions. I want you to be engaged. I want you to, really process this stuff, because this is your life. This is your money. This is your finances. Don't just rely on whoever the guru of the day is that you're listening to help you make decisions. Or I shouldn't say help you, to make your decisions for you. It's good when you have help, people to help you make decisions, but you don't want other people to make your decisions for you. You want to process this stuff. So to recap, we have infinite banking. It's going to take 10 years, as you can see. If I save $4,500 a month over a 10-year period, by around year 9 to 10, so I was more conservative, because one of the things here is dividends are not guaranteed to stay the same. They can go up, they can go down. So performance may be different over the next 10 years. So there's an unknown there. So I very conservatively said, well, by year 10, I should have somewhere around $635,000 saved up in this life insurance asset, where 90% of that money, sometimes a little bit more, is accessible for me to borrow. If you were to do the math on an amortization calculator, the number you should get, looking at going 9 years, say 10 years, 4/1/2034, I believe. I believe that's 9 or 10 years out. No, what am I saying? 2035. So you look at the amortization calculator, your mortgage should be at $544,391.41. So that's what I'm illustrating here, is that 10 years from this point, 650, 51422, 10 years out, by just making the normal mortgage payment, $4,280.75, balance is somewhere around, say, 544. Between years 9 and 10 of your whole life policy, you'll be able to borrow 544 grand out of the policy, tax-free, pay off the mortgage. Now that's done. Part 2 to infinite banking strategy, you have a couple of options here that you can do. When you take a loan out of life insurance, you are free to repay that loan however you wish. So you have complete flexibility. You get to set the terms. So to keep it simple, easy to follow, what I'm showing is basically taking the mortgage payment, the principal and interest, $4,280.75. That's $51,369 a year, and just making a loan repayment, $4,280.75 every single month, to pay off the $544,391.41 balance. And what I'm showing is a 5.82% rate. That is Mass Mutual's current loan interest rate with their high early cash value product. If I'm not mistaken, I believe it's 5.82%, or it might even be a little bit lower. So being overestimated here, it's at 5.82. And if you were to take the next 12 years or less, that loan balance should be paid off. Now, granted, that rate, this loan rate could change. It could go down, it could go up. So that's why I'm kind of giving a little bit of a range here to say, yeah, in about 12-ish years, should be able to pay off that loan balance. So what happened here? Technically, we paid the mortgage off, yes, in 10 years. But we created another loan inside of the policy. Now, granted, to the defense of the life insurance contract, you don't have to pay back that 544 if you don't want to. It's not required. Upon death, the insurance company would basically remove that off the death benefit. To give you an idea of the death benefit at year 10, let me go ahead and share my screen for you. Give you a nice picture here, and then I'll put it on the whiteboard. So by year 10, our death benefit grew to 2.45 million. We started at 1.3, we're now at 2.4. Cash value is 635. Let's say we have that loan amount at the 544. So again, you have options, just to be clear. Now, from an efficiency standpoint, I would prefer to pay my mortgage off, my loan off. I don't want to keep that outstanding forever on the policy. You could potentially run into problems later down, so you want to keep that in mind. So let's just say we incorporated a loan repayment strategy of $4,280.75 to the loan, because this is now part 2 of infinite banking. The first 10 years was saving up the cash, kind of like saving the money up in a savings account, and then withdrawing that entire savings account, paying off your mortgage in full. The difference with the savings account is once you liquidate it, right, nothing's left. It's done. Then you would take your $4,280.75 and your $4,500 cash flow, and you'd start to rebuild the savings up. Versus in a whole life, here's a pro. When you borrow out of a life insurance policy, this 635,288 number continues to grow according to that dividend rate as if you didn't take a loan at all. So you're going to keep earning interest on your money as if you didn't borrow it. Meanwhile, you took it out, you put it to use, you paid off your mortgage, you saved a ton of money in interest, And now you're paying yourself back that loan plus interest at 5.82%. And if we go 12 years out, so total 22 years is the infinite banking journey. It's 22-year journey right there. Total amount of cash value when it's all said and done, say the loan's paid off, 1.9 million, almost $2 million in cash value with a $4.1 million death benefit, and I'm 62 years old. So now what we want to do to get the full picture is let's compare that snowball to say, all right, in 9 years and 5 months, so I paid off my home sooner, which means I got to the cash flow faster. Let's say you took that $4,280.75 and your $4,500 after 9 years and 5 months and saved it in a high yield savings. Then go out till year 22 and let's see, do we have more money than this cash value when it's all said and done? Let's take a look at that. So we're going to do some math here. We're going to say 22 minus 9. So we got 13 years and 5 months. So we'll just look at 13 years, which actually makes that snowball look even better. So we'll look at 13 years. After mortgage is paid off, our cash flow is now what? 4,287.5 plus 4,500. So we're looking at 8,780.75. Let's go to a compound interest calculator. Get a little idea. And we'll start with just like 1% and then we'll increase to see how many percentage points, how much do we need to earn on a annual basis to surpass this number, 1.987. And with that snowball, we're going to have to factor in taxes into our growth. With this 1.987, no taxes. So we're looking at 8,780. 8,780. Let me go ahead and share my screen. How's everyone doing so far? If you're engaged, let me know in the comments. This is good. If you're getting tons of value, let me know. Please and thank you. So here we go. Let's see. You guys should be able to see this nice and clearly. But I'm going to zoom in a little more. So this is the structure here. For 13 years, say we paid off our mortgage, and let's say just 9 years. Say 9 years, we paid off our mortgage. So I'm giving that snowball an extra 5-month head start. And you've got $8,780 a month in cash flow. And we're going to compound that for 13 years. At 1% growth, where does my money end up? Right, and then I think I need to fix this. No, this is right. There we go, annual. So it's going to be a little bit less. So we got 1.4 million of growth. And total interest, 93,000. Now, I'm pretty confident every single one of us in here could earn higher than 1% just by sticking it in a high yield savings. Let's see what 2% looks like. 1.5. So we had, I'll put it all on the board. 1% was 1.4. 2%, we're looking at 1.5. Let's look at 3. We're at 1.6, almost 1.7. 4%, 1.79. Once we get past 4%, I'm pretty sure you'd agree that to earn 5% or more without taking any risk, probably highly unlikely. Would you agree? Let me know in the comments. If you're earning 5% or more net, okay, so that's net growth. We're at 1.925, just net growth, 1.925. If you look at gross, 5%, 1.925, then minus taxes, we have even less money. Would you agree? Total interest gained here is 546,000. Take that 546 minus 22% off of that, or even like 28, most people's tax bracket. So say minus 25%. Now we're down to 410. So more like 1.8 million. That's 5%. So at this point, we have to take risk to outperform the cash value number. Let's go 6. Once we get to 6% growth, this exceeds the whole life. But just because it exceeded it doesn't mean you have a net, right? Because you're still more like at 1.9 million when you minus taxes off of this. So let's go to 7. 7 is 2.2. And I would say you would need to earn at least 7% or more annually net after tax to be able to have a higher net number of cash value, 1.98 million. And you still, at 62 years old, if you were to just do debt snowball, take 9 years, and then save and invest your money over 13 years, you end up with somewhere between 2 and 2.2 million. But you still haven't outperformed the whole life, because not only do we have the cash value growth in here, but you also have that death benefit. Now it's at $4.1 million. We're 62 years old. At 62, every 60 plus year old client I have, they really, really value their death benefit more and more. Every single day I talk to them. Even people 50 and up really start to value their death benefit. So that's something to also consider for many of you that are processing, do I pay off my mortgage early? That's one thing that we have to overcome. Get to that conclusion. Do I want to accelerate this mortgage early? Second part of that question is, what's the most efficient way to go about doing that? And there's going to be steps. So again, if you're someone that after watching this, you're like, I should just do the life insurance. Well, we might want to take a few steps before we start that. And this is where the power of brainstorming, masterminding, coaching, conversation comes into play, where we get to process these things together and really figure out what's going to make the most sense for you. So for those of you that want that one-to-one support from me, I want to put the numbers on the board just like this, send it to you. Want me to design a life insurance policy for you? I have teams of people that can get that done. And then I myself can be a part of that process, and we can just map out these numbers together, line by line. So let's do a recap. One last time, and I want to look at some potential questions. If not, we'll close out. Quick little session. Got to know your four major numbers. Where are you currently at? What's your situation? What are your goals? What are your desires? What are you looking to do? What things do we need to be made aware of in your personal finances to help us implement the right financial strategy for you? 40-year-old male, 3 debt payoff options. These are the most known, I'd say, online. Debt Snowball, Velocity Banking, Infinite Banking. Debt Snowball have you done in 9 years and 5 months. From a simplicity standpoint, there's no thinking to it, right? You just make an extra payment every month, whatever your cash flow is. It should be done in about 9 years and 5 months. Drawbacks are no liquidity. If and when life happens, I don't have, cash flow. So I'm either going to have to borrow, or I'm going to have to stop paying off my mortgage to handle that expense. And when those expenses and things come up, they're going to be more costly for the person that's doing Debt Snowball versus the person that's doing Velocity Banking or Infinite Banking. Velocity Banking should be done in about 8.5 years, maybe 8 years and 9 months at most. At best, I'd say about 8 years, so about 1.5 years to a year sooner. And that's going to be contingent on you actually doing the strategy correctly, you implementing all the rules, having the right product to make that happen. That Snowball has the least, you could argue, lesser risk from a borrowing standpoint. But I would say Velocity Banking actually helps offset some of the risk of life events, meaning we use the bank's money to pay off our house first. We use our money to pay ourselves back, so we remained liquid in the process of that 8.5 years, and we actually got out of debt sooner. Okay. Infinite Banking, I would argue, is technically the least amount of risk and addresses most, if not all, of the variables that come into paying off your mortgage early. I think it addresses all variables. What are all those variables? Well, not only do we have to deal with life's unexpected events over the next 10 years, but during those 10 years, I'm fully liquid. I'm putting my $4,500 in an asset, and roughly 90% of that at any given time is fully liquid and available to me tax-free. I get a $1.3 million death benefit that comes with living benefits in case I become chronic or terminally ill. Okay, there's additional riders in there. In the event I pass away, if I die, my family receives a $1.3 million death benefit, which allows them to pay the home off in one shot, remove that expense, and then have an additional lump sum amount of money to replace my income. That's huge for any family, right? For any husband, any wife, kids. That's a big factor many of us don't take into consideration when we're on this debt-free journey. And then when it's all said and done, 10 years out, say you borrow, so now you're less liquid because you just borrowed your cash, paid off the entire home. Now you're going to repay yourself. And it takes about 12 years just using the 4,280.75, about 12 years. You could obviously go faster if you took this cash flow and put it toward the loan repayment. For me personally, I educate my clients and even you guys, the audience, where I'm like, hey, the interest that you pay inside of the loan, inside of the life insurance contract, all of that interest eventually comes back to you in the form of dividends. So what I encourage and teach my clients to do is continue to actually fund your policy, that $54,000 a year in this example. Keep doing that first, max fund first, because when it's all said and done, you'll end up with more net cash value and more death benefit than if you were to focus all your cash flow on now repaying this loan. So what I'm showing is 4,280.75 loan repayment, 4,500 a month, monthly contributions, adding more dollars to the cash value. That growth will outpace the loan interest costs, and the loan interest cost is going to come down as you keep paying this off. And comparing that snowball first, done in 9 years, then for 13 years, you saved and invested your money, you would need to earn at least 7% or more to outpace that $1.987 million number. So that involves taking risk. Whole life, no risk. You get a guaranteed growth no matter what. You get non-guaranteed dividends that have been paid for over 100 plus years consecutively. So you get a lot of safety and protection, as well as a death benefit, along with some living benefits as well. Now, another example we could run is, what would it look like if you chose not to pay off your mortgage early? And from day one, you took this $4,500 and you either saved it to pay it off. What would that look like? Or save and invest, a little combination of both. What we're going to do the same thing. We're going to look at 1%, 2%, 3%, just work the whole way down and see what numbers we get. Let's share my screen again. We're going to change this to $4,500 day one. We're going to look at let's look at 10 years. Start at 1%. Okay. So by just earning 1% by year 10 or sooner, you could pay off the mortgage with the money you saved in a savings account. So you actually would be able to pay off your mortgage at the same time as the person that's doing infinite banking if you just simply put your money in a savings account at the bank. Now, let's say you stuck it in a high yield savings. Let's see. Let's go 9 years. So by year 9, you're roughly able to pay your mortgage off. So at 10 years, it's like between 9 and 10, you're now able to pay your mortgage off. So it goes a little sooner, right? You got the 544 that I showed at year 10, and we've got 602 as opposed to 635 with the whole life performance. So kind of similar, but whole life still has more, right? 635 cash value as opposed to 2% growth. So we'll do 1, 2%. At 2%, I'm at 602. And I would argue it's pretty possible over a relatively long period of time, 10-year period of time, that we could probably generate maybe more than 2%. I'd say that's pretty accurate. So let's look at what 2% looks like after 10 years. 633, still not higher than my cash value of 635. So we got 635 plus you have to minus taxes on that growth. So the number is even less. Keep that in mind. So what I really need to do is I really need to earn about 4% or more. Now I'm at that 666,792 growth. And then we minus 544 from that, fully liquidate, and then keep growing the asset from there. Let's say you decided not to pay off this mortgage early and leave it alone and said, you know what, I believe let's go out 22 years till age 62. We'll even look at 30 years. So this assumes for 22 years, we simply save $4,500 a month, park it in high yield savings accounts, CDs, over the course of 22 years, earning an average rate of 4%, you'll end up with $1.893 million. It's still less than the cash value of 1.987 year 22. So that would mean that we need to earn at least 5% or more. So I'm going to write no payoff at 5%. We're at 2.1 million, 22 years. Let's see what 30 years looks like. So by year 30, this person on the board would be 70 years old. Their mortgage would be paid off because they never paid extra toward it. They just made the regular payment, and they saved and invested the difference, earning 5% over 30 years. They end up with 3.6 million. That's 30 years. And let's look at what is the policy's performance year 30. We're at 3,483. So it's less, but you have to take that $3.6 million number. We got $2 million of interest, 6414032 minus a 25% tax. You got 1.5 million plus the principal 2, 4, 5. So you're at like 3.1, 3.2. So we need to earn actually 6% or more to really exceed the growth of the cash value, to have a net more than the cash value. 6% every year, no mistakes, 30 years. So that involves taking risk now. To earn 6% or more does involve taking some risk. But it's pretty likely that you'd end up with more money over those 30 years. But it involved taking risks. So you got to keep that in mind. So I hope this gives you a healthy guideline as to what numbers I could be running to make proper comparisons, to see what's the best thing for me to do. Do I pay off this mortgage early? Yes. If so, what's the best way to go about doing it? Use these same numbers. Put your numbers on the board, put your age, put the options, run debt snowball first as your base, so you kind of have a guideline to base everything else off of. We can work together one-to-one, or you can connect with my team. We do some policy designs and look at how long it would take for the policy to grow to the point where you could borrow against it and pay your mortgage off in full. How long is that going to take? There's no question that funding a life insurance contract will take longer. But at the same time, you end up with more money later on without having to take on risk, and you provide yourself with the most amount of protection, and you remove most of the variables that come into place when accelerating your mortgage early. And with Velocity Banking, it was simply a matter of speed. So Velocity Banking does go faster, about a year faster. That might be really attractive. That's why a lot of us watch this channel and we learn how we can go faster when it comes to paying off other debts. When it comes to the mortgage, sometimes I'm 50-50. Sometimes I'm like, okay, when we get to a certain point of cash flow, income, credit, age, now I'm like, hey, let's look at the life insurance part and compare it to Velocity Banking. And we can match those neck and neck and see which one makes the most sense. And to this day, in my practice, I've got like a 50-50 split. It's like 50% of my clients are working toward funding a life insurance asset, then borrowing against that to maybe accelerate debt. Other 50% are just doing Velocity Banking with their PLOC, credit card, HELOC. And then eventually, what I always say is we don't want to stay in Velocity Banking forever. You eventually want to graduate. So I look at infinite banking as like a graduation process. We ultimately want to end up in that camp, because it's not just about paying off debt, being debt free, but it's also about building wealth and creating generational wealth. Life insurance is a key fundamental asset to create generational wealth, remove key risk, remove risk altogether, but yet still have guaranteed tax-free growth, liquidity, accessibility, more than any kind of qualified retirement account. It's amazing stuff. So let's process all of that together. I'm not seeing any comments, and I'm wondering if I have a setting on my YouTube by accident. I got 17 people here. Do me a favor. Can someone drop a comment? I just want to see if there's an issue on my end, because I haven't seen any comments come in. I'm wondering if you guys have been trying to comment and you can't, or if it's a setting on my end. Doesn't look like it. Let me know. I'm not seeing any comments. So I'm guessing there's an issue with YouTube, because usually there's always comments, like even before I go live and right when I go live, you guys are saying hi, hello. So something might be going wrong with YouTube. So unfortunately, I'm not able to see any comments coming in. If you have been commenting, that is definitely on YouTube because I have the settings all correct. But reach out to me directly. Click the links below. Jump on a call together one-to-one. Get inside my community. Get on my email newsletter. I'm hosting classes all the time, private workshops where I can interact with you a little more in a group setting and have some fun, run some numbers. So again, hopefully this video was a nice little guideline, kind of help you process this. Again, I don't look at it as right or wrong answer. It's about like efficiency. What's going to make the most sense for me to do in this season of life that I'm in? Is it simply a matter of I need to just build discipline? I need to prove to myself that this can work? Or is it a matter of I'm looking to do something a little more advanced and I'm willing to stay committed and disciplined and I like a little more complexity because it ultimately ends up with, say, I get more benefits long term. All right. So I will close it here. God bless you all. Thank you for your time. And I look forward to hanging out again soon. God bless. Talk soon. Bye now.